Hey everyone, and welcome. Today, we're taking a really fascinating document, the central bank's latest, highly anticipated monetary policy statement, and we're going to unpack the real story together. You know, economic policy statements can often feel like this dense wall of jargon and complex data, right? But we're stripping all that noise away. Using just the direct facts, figures, and quotes right from the source, we're building a clear, straightforward narrative. By the end of this explainer, you're going to have a really firm grasp on where the economy actually stands, where inflation is heading, and how these high-level decisions ultimately impact our everyday markets. Let's get right into it. Okay, let's dive into this. Here is our roadmap for today's explainer. Number 1, the big rate decision. 2, tracking India's inflation path. 3, GDP and economic resilience. 4, navigating global economic storms. And finally, number 5, new banking and policy measures. All right, segment 1, the big rate decision, bottom line up front. This right here, this is exactly the moment the financial markets were literally holding their breath for during the committee's 3-day meeting. After looking at all the evolving macroeconomic data, the Monetary Policy Committee unanimously decided to keep the policy repo rate unchanged at exactly 5.25%. By holding firm on this number, the committee is basically signaling a steady hand. You know, they're keeping the current cost of borrowing steady for now, rather than prematurely tipping the scales in either direction. Because of that, the other key rates are staying put too. The standing deposit facility is unchanged at 5%, and both the marginal standing facility and the bank rate stay at 5.5%. But I want you to pay close attention to that very last point. The MPC decided to retain a neutral policy stance. This is absolutely crucial for everyday borrowing and lending. Why? Because a neutral stance means the central bank isn't boxed into either raising or lowering rates in the near future. They are staying highly vigilant and keeping their options wide open so they can react to the economy as things actually unfold. Let's move on to Section 2, tracking India's inflation path. It is a delicate balancing act. Now, what's really interesting about this slide is the striking contrast right now between the two main types of inflation the central bank looks at. On one side, we have headline inflation, which has edged up above the target. The source notes this increase, like the recent bump to 4.4% in June, was mostly driven by food and fuel costs, and it's even trickling into things like restaurant services. But look at the other side. Core inflation, which strips out those highly volatile food and fuel prices, tells a totally different story. It has remained flat at 3.9%. In fact, if you take out precious metals, core inflation was even lower, sitting comfortably between 2.3 and 2.5%. So we're essentially in an environment where underlying inflation is quite benign, but volatile external supply shocks are pushing that headline number up. Looking across the financial year, overall consumer price index inflation is projected to average 5%. But just notice the volatility quarter to quarter here. We dip down to 4.7% in Q2, but then we expect a spike up to 5.9% in Q3. The committee thinks inflation is going to peak right there in Q3, almost entirely because of those food and fuel pressures we were just talking about, before eventually cooling back down to 5.5% in Q4. Basically, the expectation is that as supply pressures ease, headline inflation will eventually come back down to match that much calmer core inflation rate. So why did the governor explicitly call this near-term outlook hazy? Well, just look at the headwinds we're dealing with. The agricultural outlook is currently clouded by deficient and uneven southwest monsoons, thanks to El Niño. Sure, reservoir levels are close to normal, but the actual timing and spread of the rainfall is a massive risk. Throw in the re-escalation of the West Asia conflict since early July, and you've got a recipe for highly volatile energy prices, sharp swings in global oil markets, and totally renewed uncertainty for global supply chains. These are the specific, unpredictable downside risks forcing the central bank to just wait for a bit more clarity before making any major moves. Moving right along to Section 3, GDP and economic resilience. This is the domestic anchor. Despite all those hazy inflationary pressures, the domestic growth story provides a seriously solid foundation. The central bank was actually super optimistic here, officially reaffirming India's position as the world's fastest-growing major economy. Retaining that title while the rest of the world is in chaos, that is genuinely impressive. And the source attributes this straight to highly resilient domestic demand. We're seeing sustained expansion in manufacturing, which is backed up by an expansionary purchasing managers index. Services are keeping up their momentum thanks to strong discretionary spending, and merchandise exports have actually bounced back with double-digit growth. Even with all the global noise, the domestic anchor is holding absolutely firm.
Let's move to the data and see how this builds across the financial year. Real GDP growth is projected at a very impressive 6.7%, which, by the way, they noted is actually 10 basis points higher than their previous projections. Looking at the quarterly breakdown, we start off really strong at 7.0% in Q1. We do see a slight dip to 6.4% in Q2, but then a steady climb back to 6.5% in Q3, finishing out the year strong at 6.8% in Q4. The committee sees the risks to this growth as evenly balanced, firmly anchored by strong credit flows and the government's continued push on infrastructure.
Section 4. Navigating global economic storms. External sector strength.
Okay, so domestic strength is fantastic, but we obviously don't exist in a vacuum. The global environment right now is dealing with softening growth, shifting trade policies, and just a lot of volatility. However, the external strength of the domestic economy tells a wildly compelling story of global confidence. Just look at the gross foreign direct investment inflows. In the first quarter of last year, gross FDI was at $26.7 billion. In that same period this year, it has surged to a massive $30.7 billion. That jump powerfully underscores how global investors are still incredibly interested and confident, even while international markets are all over the place. And this brilliantly illustrates how these inflows aren't just big numbers on a spreadsheet. They are an actual formidable shield against external shocks. Foreign exchange reserves continue to be highly adequate, giving an import cover of over 10 months and covering almost 91% of external debt. Beyond that, the economy has some serious momentum going. The current account recorded a surplus of $2.8 billion across April and May, largely supported by services trade and strong remittance receipts. Plus, there was a massive turnaround in foreign portfolio investment, bringing in net inflows of $7.1 billion in just June and July. Combined, these robust buffers let the central bank navigate global shocks with real confidence.
Which brings us to Section 5. New banking and policy measures. Enhancing consumer protection.
Behind all these big macro numbers, the central bank is making specific regulatory tweaks that directly affect the cooperative sector and everyday consumers like us. First up, they are issuing draft guidelines to revive licensing for urban cooperative banks. Second, they're finally revising the 2008 credit monitoring systems for rural banks to match modern realities. But honestly, the biggest win for everyday borrowers here? A targeted push to completely harmonize and standardize the regulatory framework on interest rates for advances. Basically, they want to cut through the fine print to guarantee true transparency in lending rates, making absolutely sure borrowers always have clear, easy-to-understand terms. And that brings us to the governor's resolute closing remarks. Set against a backdrop of really challenging global conditions, wild energy markets, and lingering trade uncertainty, he delivered this statement with absolute conviction. Whether it is preserving stability of prices, the financial system, or the currency, we will do whatever it takes to ensure the same. It is just a very powerful reaffirmation of the central bank's totally unwavering commitment to macroeconomic stability, making it clear they'll use their entire toolkit to stop any disorderly movements in the economy. Which leaves us with this final critical thought. The source notes that global inflation forecasts are actually projecting higher for 2026 compared to 2025. So the big question moving forward is this. As global trade policies shift and external inflation risks continue to loom, will these undeniably robust domestic buffers, the massive foreign exchange reserves, the resilient domestic demand, and that 6.7% growth rate, actually continue to effectively protect the everyday consumer's wallet? It's the central question the committee is watching, and it's definitely the one we should be paying attention to as well. Thank you so much for joining me for this explainer.